This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and once again this week we've got a packed show of a variety of topics. We'll talk a little life insurance on the program today, not a topic that we spend a lot of time talking about, but certainly over the years we have. We thought we would revisit that, particularly with a statistic that we saw involving group life insurance, like the kind that your employer offers. And then, of course, we'll talk about the week that was, as we do on the program regularly, and the kind of the newest acronym out there. You hear a lot about the FANGs, but have you heard about the WABUs? WABUs? I think I'm saying that right. The FANGs or the WABUs. We'll talk about that. And, of course, we have open lines and open forms of communication. So if you want to add in your topic of conversation, you are most welcome to do so, either by dialing the number 407-916-5400, toll free 1-866-916-5400. Feeling a little shy, don't want to get on the radio, you can send us an electronic message, otherwise known as an email. That email address is my first name, Joel, Joel, at, that's the A with a little circle around it, NelsonFinancialPlanning.com. That's how you can get in touch with us and add in your topic du jour on today's program. Before we get to all of those topics, though, I came across this one, and the perspective and the perception of the public at large is very much laid out by the media. Now, that's not, I guess, a very shocking comment, but when you hear it relate to the markets and you hear statistics like what we're going to share with you next, it really does kind of make you think just how much the media shapes our perception, and that they can do it, and to the extent that it's not even correlated to reality. Here's the statistic that explains that. According to this survey, 2,000 American adults were surveyed in August of this year. 48%, so that's half, thought the U.S. stock market had been flat over the last 10 years. Another 18% of those same 2,000 folks thought the U.S. stock market had declined over the last 10 years. So you've got 70% of the population either believing that the market has been flat or down over the course of the past 10 years. Yeah, that's about as far from reality as it could possibly be. But stop and think about that. You got 70% of the population believing that the market was either flat or down over the course of the past 10 years. Where is that coming from? Well, the only explanation is that every time the markets dip a little, you hear that disproportionately than you do the overall trend. Because the overall trend, going back the past 10 years, if you look from that 10-year period of time, there is, in fact, 11 different times during that 10-year span where you saw declines of at least 5%, but not more than 20%. Okay, so anywhere from 10 to 15%, there was 11 of them in that 10-year span. Clearly, the media fixated on those 11 periods of time and kept you on your edge of your seat expecting when the next one was going to happen. The problem is that your perception and reality are completely different. Because when 70% of the American population thinks that the market has gained anything or gone down over the course of the past 10 years, that's a problem in perception. That's a problem in information. That's a problem in getting sidetracked and distracted based upon what the media is feeding you. Harping on those 11 times over the past 10 years where the markets have gone down. But along the way, perhaps, well, not perhaps, 70% of the population missed the overall trend. The overall trend over the past 10 years has the market up about 8-9% per year every year. Now, if you make 8-9% over a 10-year period of time, you know what you do? You double your money. Does that sound like a flat result? Does that sound like a negative result? But yet 70% of the population believe that. Stop and think about that. That's how far off or how much influence the media has on us. That you believe something to be true even when it is the furthest thing from the truth. It's just shocking when you stop and think about that. You've had a period of time, a recovery period of time, post-2008, where the market has clearly responded incredibly strongly, particularly over the past few years. And yet you got 70% of the population thinking that nothing was going on. Wow, huh? I mean, that's pretty surprising. Be careful of the story that the media wants to feed you, because that story is one that is based solely upon bad news, and bad news is coming around the corner, and the music always ends, and, you know, the world's going to come to an end. The problem is that there is a whole different story actually happening out there. So be careful. Fascinating, right? 70%? 70%. Wow. Have the general direction of the market completely wrong over the course of the past 10 years. It's pretty shocking when you stop and think about it. So then these numbers and these statistics that say there's so much, so many people, investing, and that's driving the market up. Well, it's not what the numbers say. Okay, so I would counsel you to be mindful of what the real statistics are. To find that stuff, you really got to shut the TV off and seek your information more in the printed form. And the reason for that is because printed form, while certainly choice of words matter and certainly things can be written in a certain way, at least there doesn't come with it the emotional tone or the constant harping of a negative cycle. Pretty dramatic statistics. Speaking of drama, my goodness, there was a bit of drama this past week, right? In the headlines and in the markets, and I guess as things were playing out in Washington with the Supreme Court nominee Kavanaugh's hearing and all of that back and forth, the markets, kind of took a yawn, if you will. And for the month of September, the markets were positive. As a matter of fact, for the third quarter, so interestingly, the third quarter is now behind us. Hard to believe that that we're 3 quarters of the year through 2018, and tomorrow marks the official beginning of the fourth quarter, October the 1st. So third quarter is officially in the books. Hard to believe. And for the quarter, it was actually a pretty decent quarter in terms of performance. The major indexes, once again, were quite positive, generally up anywhere from 6 to 7%. Again, I wonder if you surveyed these same 2,000 people, whether they would realize that the market was up during. Obviously not, because they think the market's down or flat. But certainly, the strength of corporate earnings helped drive the markets. And so for the third quarter, the markets were quite positive. A big yawn on the Kavanaugh hearing. I mean, it underscores the fact that markets really do act independently of what the politics are. Do they act independently of Federal Reserve rate hikes? No. And that did happen this week as well, as the Federal Reserve raised interest rates by 0.25 point. It was the 8th increase since 2005, and the markets did react to that. So for the week, the markets were down about 1%, but for the quarter, certainly up quite strong. So the statements that you'll get, if you get your statements on a quarterly basis, those statements that you'll be getting here in the next couple of weeks or so will, in fact, be show some pretty decent numbers, assuming that you have an allocation that is more on the equity side and that you're not sitting too heavy on the bond side. Because if you're sitting too heavy on the bond side, then, you're not going to have had much of a return. That's why we keep talking about investment allocations being way too heavy on the bond side. Be careful of that. And make sure that you are not too heavy on that side of the equation. As we look ahead, the week ahead, you've got, I guess, more Kavanaugh stuff, right? I guess because it was a week delay, so then by the end of the week, I'm sure that will be surfacing it's rearing its head again. And then also this past week had some progress on the tariff side the tariff side of things, which I guess the mainstream media describes as trade war. I think it's really just more of a conversation, especially when you look at what's actually happening. So this past week, free trade pact was signed with South Korea and still in negotiations with Japan, still trying to get Canada on board, signed a deal with Mexico. It looks like a deal is to be had with the European Union. You got some basically some regulatory issues on that, and then China. That one kind of is back and forth, or more in a back and forth positioning. So those also kind of had some headlines this past week as well. But it seems that on that front, you're getting some level of you start to see some of these countries start to sign these deals. You're starting to see some level of progress, and so that becomes less and less of a concern for the markets as a whole. Again, media is going to fan it, is going to make it a bigger deal than what it is, and tell you that it's going to bring everything to its knees. I don't think it ever gets to that point. That's just not the approach of the current administration. If you look sort of at their pattern. That's just not what it turns out to be. But stay tuned for more on that. Like we said, the week ahead, big data coming out on Friday, or the biggest data coming out is coming out on Friday, which is the employment report. Jobless rate is expected to fall to 3.8%, which would be the lowest since the year 2000. As a matter of fact, it hit 3.8 in May. So it would tie that record, which goes back to the lowest since the year 2000. So that is the week ahead as we start the fourth quarter. We will slide to a break here on the program. When we get back, we're going to talk a little bit about some life insurance, particularly group life, term life, those types of things that you may be being offered by your employer as an option. Because after all, this time of year is the open enrollment, so you're going to be faced with those types of decisions as well. So we'll talk more about that when we get back here on the program. Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 93.1 WFLA. So this time of year, start of the fourth quarter, is typically sort of that open enrollment period with your employer, where you get to sort of pick what benefits you want and how you're going to spend those benefit dollars. Often, many of those decisions revolve around your health insurance or your dental insurance or your vision insurance, and certainly those are some of the more important decisions to make. As a side comment on the health insurance side of things, particularly from an employer perspective, we continue, as we sort of look at and survey the landscape, we continue to think that a high deductible plan with a health savings account, particularly if you're somewhat healthy, is a pretty good option. The health savings account in particular is basically triple tax deferred. When you put the money in, you get a tax deduction. It grows along the way tax deferred, and then when you take it out, it's tax free, assuming you're using it for medical expenses. That's pretty powerful stuff. And the best thing about that, and again, here's where perception and reality differ. Many people get the health savings account confused with the flex spending account. The flex spending account is one where you've got to use it by the end of the year or else you lose the money. The health savings account does not operate that way. The health savings account, whatever the balance is, you carry it over to the next year. And that carryover feature allows for that health savings account to be a very powerful vehicle, not just to help with your health costs, but when you turn age 65 with the health savings account, excuse me, then you wind up having to be able to use that money for whatever else it is that you need for retirement. So it's really a pretty powerful option. So we would encourage folks to kind of look a little bit more at that option as they survey their choices. But today we wanted to talk about one of the other options that many employers offer, and that is life insurance. And it's estimated that about a third of folks who work for an employer that sort of offers a suite of options that you can pick, a third of them will own a group life insurance policy through their employer. Of that third, 70% of those that purchase will have a death benefit of no more than $100,000. So there's a lot of information in that statistic, and we're going to unpack it. First of all, a group life insurance policy is only available to you while you are working for that employer. It is not insurance that will carry with you if your employment situation changes. Yes, typically there is a conversion feature, but if you've done any sort of price comparison on those, you will find that having your own standalone term insurance policy is a much more cost-effective option. It's amazing, just how often people hit the easy button and say, oh, I'll just do it with my employer. But the reality is that if you look at some of the costs, particularly on these group policies, and you compare them to what you could get for those same dollars on a larger standalone policy, you may very well be surprised that there isn't really a whole lot of difference. There's not really a whole lot of savings with these group policies, combined with the fact that if your employer makes a decision to do away with that as an option, then you no longer have coverage. So really, to the extent you need life insurance, and generally, if there's young kids in the house, is still a mortgage on the property, those types of things, that would be a situation where you would want to certainly have some life insurance to be able to replicate your income should anything happen to you. The reality is that in order to get that kind of coverage, you have to get a pretty good sized policy. So let's say you're making $75,000 a year. How much life insurance do you think you would need in order to replace $75,000 a year should you die tomorrow? It's a much bigger number than most people realize. The rule of thumb, in fact, is 8 times. So 8 times, 75 is a pretty big number that I can't do in my head, so I'm cheating. And while I'm talking, I'm doing it on my calculator. It's 600,000. See, if it had maybe an extra cup of coffee in this morning, I probably could have figured that out in my head. But anyway, 8 times 75, that's 600,000. So I got 75. So I got $600,000. It would effectively need a $600,000 policy. Well, that's going to be relatively costly on the employer side, and it's not going to be able to carry with you. Meanwhile, if you get a term policy, remember that the rate and the cost based upon the age that you are when you get the policy. So the sooner you get that policy, the sooner you lock in that lower rate or that lower annual cost for the period of time where you're going to have that insurance. Because understand how term insurance works. It's basically just providing you coverage for a set period of time, hence the name term. What that does, though, is that allows the cost to be much more cost-effective than, say, if you were getting a whole policy. If you get a whole life insurance policy, then to find a $600,000 cash or death benefit, you're going to be paying a tremendous amount more money into that to be able to fund that policy. Meanwhile, if you're planning your retirement and your investments properly, at some point, having life insurance when you approach retirement should not be a necessity, because you should have saved up the money, should have been paying off the mortgage, should have been doing those types of things, which sort of eliminates the need to have a life insurance policy that lasts with you for all of your life, combined with the fact that the cost of that whole life insurance policy, particularly the insurance cost component of it, really increases the older you get. So oftentimes what we're left with is if you do have that policy and you're in your 70s, you're looking at a big premium or the insurance cost eating away now at the cash value, and you're stuck in sort of a no-win situation. But the term policy is a great option to get because you set the amount that you have to pay each and every year at that point in time when you get it. Now, here's the thing. You've got to make sure that you've got the right level of insurance, because when you look at these statistics and you've got 70% of the people that are getting group term insurance through their employer and the value is less than $100,000, how long do you think that's going to last if you're making $50,000 or $75,000 a year? It's going to last basically a year or two. That's not – insurance might help, having that insurance payment come in if something happens to you certainly would help, but it's not going to solve the problem of your disappearance of income. So we want to run these numbers a little bit more in detail, and we're gonna do that because I think this is a pretty important topic. So we're going to slide to the break because it's the bottom half of the hour, and then when we get back, we're going to continue this conversation about insurance and the group term that many employers offer, and then continue to contrast that versus a standalone term policy. We highly recommend going with the standalone term policy option. We'll explain more of that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA, and of course simulcasting over on 540 AM. Hello to our AM listeners as well. I think the suits, as Jack used to refer to them, always want to emphasize the FM dial, but the AM dial still hangs out there on 540 AM. So we welcome all of our AM listeners as well. This is Joel Garris of Nelson Financial Planning. Talking a little bit on the program today. It's that time of year, right? We are, the third quarter is done, or effectively done at the end of today. Fourth quarter starts tomorrow, October 1. Happy October, right around the corner here. And my goodness, then we'll start to accelerate to the holidays pretty quickly. Another thing that happens in sort of this time is employers will give you the opportunity to select different types of options or different ways to spend your benefit dollars. And one of them that comes up, and it's kind of an interesting, kind of one, is this term life, group term life that you can get through your employer. Many employers, in fact, will offer it as many employers will offer it as an opportunity to really go and help give it an extra employee benefit. But the problem is that they might do 1 or 2 times salary. Well, as we were explaining before the break, if you just wind up doing a very simple analysis, if something happens to you and you lose your income, then guess what? Then your income is with a policy that's only 1 or 2 times your earnings, then your income basically is covered for the next year or two. But beyond that, you still have not solved the problem. So that's fine to have that as a standard benefit. Our recommendation is before you go and spend more of your dollars, your benefit dollars, on getting more of an insurance through your employer group term policy, we would encourage you to look for a standalone term policy as a better use of those dollars. So bottom line, if your employer's giving it to you for free, well, then sure, take it. But it's not going to provide the level of coverage that you're going to need. It's not going to satisfy your life insurance need to have your income get replaced when you have young kids or when you have a mortgage. Let me be very clear on this. Your plan should be that you do not need life insurance when you're 65 or 70 or 75, because by saving money along the way, then you have your expenses covered, because that's the whole process of retiring in the first place. Okay? So the point of having life insurance is to be able to replace your income should something happen to you on an untimely basis. By the time you get to retirement age, you should already have the tools in place to replace your income. It's called saving for retirement. When you retire, right, you wind up getting income from your various assets that then effectively generates money on a regular basis. Some exceptions to that, okay, when perhaps maybe one spouse has a pension where it's solely based upon their life. Obviously, always exceptions, okay? But I think conceptually, the need for that life insurance at those ages really disappears, or should disappear, if you've sort of planned things the way that they need to be planned. Always exceptions to that. Let me be clear on that. That's why the invitation is always available to come in and have a conversation at our office about any of the topics that we cover on the program. But I think conceptually, more people have that tendency to have these whole life insurance policies that really are very, very costly and don't really do the trick. So if you're thinking about having some type of insurance coverage, rather than use the employer group term, really look at getting a term life insurance policy that is a standalone policy whereby the rate, here's how term life insurance policy works. If you get a term policy at age 35, then the rate that you're going to pay for the remaining period of that term, 20 years, will in fact be the same. So it won't change along the way. Meanwhile, as you get older with a group term policy with your employer, you're going to go into different age bands, and so that's going to change how much you have to pay for that coverage. So really want to encourage you as you're looking at your employer options, how to spend those dollars, particularly this time of year, that certainly take what the employer gives you for free, but really don't commit more dollars to that part. Really look at having your own standalone policy as a separate item that you have that will stay with you, that regardless of whether you change your employer, will still be your policy. To get stuff like that, term life insurance, very commoditized these days, meaning that it's available very easily on the internet. There's a variety of websites that offer it. We encourage you to explore that because it's all pretty much a standard product these days. So really think about that as you're going through those benefits and you get to that life insurance one. Take what the employer gives you, but before you commit to loading up on a term policy that isn't really it's a term policy, but it's really only a term policy for a year, because then the next year it's still open enrollment and you're renewing it again, versus a standalone term policy where it's yours and you own it personally, and the amount that you're paying is good for each and every year until for the entirety of that term. So I thought we would talk a little bit about that here on the program. Certainly this time of year with open enrollment and having that conversation or starting to look at those benefits, you may be wondering about what to do about that particular aspect of it. So you've heard us talk about it before, and certainly it is making the rounds on in the media. You hear all the time about the FANGs, right? The FANGs, which are simply an acronym for Facebook, Apple, Amazon, Netflix, and Google. And although Google is not called Google anymore, it's now called Alphabet. But anyway, back in the original incarnation of the acronym, it was in fact Google. So the acronym of the FANGs came up, and it's funny. We've got the U.S. version of that, which is the Facebook, Apple, Amazon, Netflix, and Google. But similarly, China does as well, and theirs is called the BAT, which is Baidu, Alibaba, and Tencent. So no matter where you go, you've got these digital companies, these technology companies that are sort of internet type based, where their revenue and their stock price has really increased dramatically over the course of the past 5 years. So you've got the FANGs here in the U.S., you've got BAT over in China. When you start to look at that, at the numbers and the revenue that these companies are making relative to their stock price, you certainly do have the suggestion, at least, that perhaps the price is getting a little bit too far ahead of itself. And so consequently, there is other ways to sort of look at it. And there's a new acronym that's being suggested out there, which is WABUA, which is apparently a genus of spiders in New Zealand. But what it really stands for is a focus more on revenue as a fundamental way to measure the stability and the profitability of a company. So the acronym WABUA, which you may start to hear more and more of, is basically looks at the top 5 revenue-producing growers in the S&P 500. Now, remember, here's the thing about revenue. You really can't sort of manipulate it too terribly much because revenue is revenue. Dollars coming in, okay, how you spend those dollars and how you account for them and whether you borrow money to do a share buyback or whatever, the revenue really is the top line number. And so if you look at the largest revenue-producing companies, that's where this new acronym, which involves Walmart, Apple, Berkshire Hathaway, which is Warren Buffett's company, United Healthcare, and Amazon. So a couple of companies overlapping versus the FANGs, but the new acronym that's being floated around out there, and we'll see whether it takes on as much as the FANG acronym, really looks at kind of top line revenue and looks at those companies that are generating revenue and the most amount of revenue. And interestingly, it's companies that we all know very much. It's the Walmarts, the Apples, the Berkshire Hathaways, United Healthcare, and Amazon. So stay tuned. See if you will hear more of that acronym as a way to help separate out different types of companies from an investing perspective. We'll have more thoughts on this acronym along with open lines for you as well at 407-916-5400, 866-916-5400. And, of course, the email, Joel at Nelson Financial Planning. We'll be back after this commercial break here on Dollars and Cents. Joel Garris, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. I was talking a little bit earlier in the program about the time of year where it's time to choose those employee benefits. We forget, from an employer perspective, just how much that all adds up. And if you look at a statistic from the Bureau of Labor, they estimate that for every $1 that is spent on wages and salaries in the private sector, employers spend an additional 44 cents on benefits. So average compensation at $23.78 per hour. The cost of benefits averages an additional $10.41 per hour. So stop and think about those numbers, particularly when you hear some of the political debates that happen out there, is just how much those benefits that employers provide do in fact cost. According to the Bureau of Labor, own government agency, so this isn't some private group making it up, for every dollar spent for wages and salaries in the private sector, employers spend an additional 44 cents on benefits. So if you think of average compensation, which works out to $23.78 per hour, the cost of those extra benefits puts an extra $10.41 per hour, effectively making the cost to be, or the value of the job, which includes the benefits, to be on average $34 an hour. That's a pretty significant difference and a pretty significant way of thinking about it and how that compensation comes into play. And I think that's why many employers are starting to present, kind of to the employees, excuse me, just how much money that folks are really making, is they're presenting it in the form of, well, here's your salary, but then also here is the value of your benefits. And so consequently, you wind up having a sort of a better picture of that additional cost, which is quite a bit of a cost for employers. When it's adding, basically 44% on top of the current wage as it is. We also were talking in the prior segment about sort of the new acronym that's floating around out there. We'll see if it takes hold as much as the FANGS acronym or the BAT acronym out of China. But a lot of those companies that are in those acronyms have generated certainly a good revenue, but also you start to see their stock price be much higher as well. So the suggestion is perhaps the stock price has gotten too far ahead of where it might be. If you look at companies, on the other hand, that are sheer revenue producers in terms of generating top-line income, that's where the WABU acronym comes in, looking at those companies that are generating more of a pure revenue stream rather than because with the revenue number, you can't really make that up. There's a lot of things that you can do on the books in terms of debt and in terms of write-offs and things like that to kind of adjust the numbers before you'll get to a kind of a bottom line. Here's our profit. With revenue is revenue. It's the top line number, and certainly the suggestion is to look at that more than some of these more tech companies that have been having a big increase in terms of their overall price. So that acronym, Walmart, Apple, Berkshire Hathaway, United Health Group, and Amazon, a little bit more of a diversified basket, if you will, of companies rather than just all companies that are kind of in the technology or information technology space. So some interesting analysis there. We will see if that holds weight or gets as much traction as the FANG acronym has been. So stay tuned for that. One other word about employee benefits. Again, really look at how you're spending those dollars, particularly on the health insurance side of things, because that always is costly. Just know the distinction that exists between a flex plan and a health savings plan. A flex plan, those dollars expire at the end of the year. A health savings plan, they do not. Now, the limitation is on a health savings plan, you have to have a high deductible insurance plan that works in conjunction with it. It has to be a qualified high deductible plan in order to have that be a health savings account in the first place. So, but certainly that health savings account is a great option. And from an insurance perspective, the life insurance part, bottom line on that, take what your employer offers, but go out and get your own because then that policy will stay with you for the entire time, regardless of whether you work for the employer or not. And you also, when you get a standalone term life insurance policy, the rate, in fact, won't change over the course of the term. That's the point of a term policy. And the sooner you get that, then the sooner you get the benefit of getting it at a younger age, which means then that your insurance cost will, in fact, be much, or at least it will be established at an early age rather than it constantly sort of increasing over time. So hopefully that was an interesting conversation on insurance. We don't necessarily talk a whole lot about that on the program these days, but it's obviously a very vital part of your overall investment picture and investment profile. So then we will be back next week on the program, and we will certainly be posting the show on the social media platforms tomorrow. So if you missed a part of the show or just want to hear it again or want to refer a friend to it, you can certainly do that with any of our social media channels. And all you need to do to find us on those channels is just go to our website, which is simply nelsonfinancialplanning.com, and click on any of the number of icons in the upper right-hand corner, and that will direct you to that. So enjoy the rest of the Sunday. It looks like a beautiful day out there. We will wrap up the program here on News Radio 93.1 WFLA. This is Dollars and Cents with Joel Garris, Nelson Financial Planning. Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.